In this lecture, we'll be discussing revenues and taxation. In the previous chapters, we focused on the expenditure side of the budget. Now we will turn to revenues and the types of taxes that governments have in order to generate sufficient revenue to fund their own activities and pay for expenditures. Most governments need to engage in some sort of revenue collection or tax collection in order to fund the many activities that government does. So, especially with regard to public goods, and we have talked about why government needs to provide those public goods. Otherwise, no one in society on their own will bear the cost of providing these public goods. So, government needs to have sufficient revenue, whether from tax revenue or from other sources of revenue, in order to pay and provide for public goods. Increasingly, as well, as we said, there has been demand for more and better services from citizens, even including uh, services such as education, healthcare, so services that have some positive externalities. And so government needs to engage in these, whether these will be funded from taxes, from some sort of combination between taxes and fees, whatever the means are. So the demand for services by citizens necessitates the collection of revenues, taxes, and fees. Also, we were talking about the role of government in redistribution of income and distributing wealth and income across the society, as well as having social safety nets to help those who are unable to generate sufficient income for a decent living standard. And so revenues and tax money is also used by government to perform some form of redistribution of income in society. And most governments rely on tax income specifically to cover most of their expenditures, while there might be some other sources of revenues, such as maybe grants, such as maybe if the government is running public enterprises, so it engages in some form of productive activities that generates revenues, whether it has some natural resources that generate revenue for the country. However, the majority of tax of revenues for uh, the majority of countries, or a substantial number of countries, is coming from tax revenues or tax income. So if you look here, for example, for the composition of revenues in Egypt during the 2018-2019 fiscal year, you see that tax revenue constitutes more than 76% of total revenues generated during the fiscal year. So that so the majority of funds used to pay for the expenditures of the Egyptian government is coming from tax revenue. So just as governments plan their expenditures, they also plan their revenues and taxation. And so whenever governments plan for their tax design and tax policy, or are making estimates for a fiscal year or whatever, they have to ask questions about what are the revenue sources we have, how much can we generate from the taxes collected or from other sources of revenues, are we considering any types of reforms to taxes, so reforms to tax rates, introducing new taxes, reducing taxes, raising taxes. So these issues are of concern for governments when they think about the size of the revenues and the amount of taxes that they can collect, either in one year, or if they are planning over multiple years, or if they are thinking about the tax policy and the types of taxes, and thinking about reforming the tax system or the tax policies in the country. And so when thinking about taxes or the types of taxation and estimating how much revenue government can think or government can generate from the different types of taxes, there are a number of issues or a number of criteria that decision makers will have to take into account in order to correctly estimate how much revenue they can generate, what types of amendments or reforms or changes that they can do to their tax policy or their revenue streams so that they can correctly estimate how much revenue they can get, and so as not to or in order to make correct policy choices about the types of taxation that they want to introduce or reform, or the tax rates, and so on. So there are criteria, or what we call taxation principles, that decision makers usually have to think about and take into consideration when thinking about tax design, tax policy, or estimating revenues in any given year. So when designing tax policy or when estimating revenues, decision makers will have to consider, or usually consider, these six principles of taxation, or these six criteria, which are the revenue potential, that's the amount of revenue a specific tax source can generate. There are some equity considerations related to the fairness of the taxes. There are some economic efficiency considerations to take into account. The cost of administering the tax, or the cost of collecting the tax, the political feasibility of certain taxes, so whether we can actually implement those taxes or whether we can reform or introduce new taxes, and finally transparency, the transparency with which the taxation is being implemented. And we are going to go into these six criteria in much more detail. The first principle to consider when taxpayers are looking at tax policy, or when evaluating taxes, is the revenue potential of taxes. So, how much tax yield a particular tax can generate. So, the amount of tax money that can be collected from a tax. And so, here we look at the size of the tax base, and the tax rate at which the tax base is taxed. So by tax base here we mean what is being taxed, the activity that is being taxed, or the income or wealth that is being taxed, or upon which the tax is applied. So some taxes have a large tax base. So for example, income taxes. So income taxes usually have a large tax base because in most countries, a large percentage of the population work and earn income, and so this income is subject to tax, and so usually have a large tax base. Even at lower tax rates, we can still, or government can still generate a large amount of taxes, or a large amount of tax yield from this tax base, and especially also because taxes, income taxes tend to be progressive, then we can expect to have a large tax yield because higher income earners also pay a higher percentage of taxes, and so the tax yield is usually large. So, uh, taxes, or types of taxes that have a large tax base and have the potential to generate a large tax yield, are usually very attractive to decision makers to have this in, or to apply this type of tax. So income taxes is one, whereas if you look at taxes on cigarettes, for example, these are usually, they don't usually have a very large tax base compared to income taxes, because this is only applied to the sales of the cigarettes. So for only those population, or those people who purchase cigarettes, so you don't have as much a large base compared to the income tax. In addition to looking at the size of the tax base and the tax rates, also important here is the potential for this source of taxes to grow. So not all taxes or not all types of taxes have the potential to grow as fast as income or wealth. And we know that citizens in most societies, as their income increases, as their living standard increases, they have a tendency to demand more from government. They have a demand for better services for government, for more efficient government, for uh, for a variety of services and for better quality services. And so in order to cope with that, government as well has to uh, to have sufficient revenue to cover these expenditures. And so types of taxes that have a potential to grow even at existing tax rates are also attractive in this sense. So again, income taxes usually have a potential to grow as people's incomes grow, because income taxes tax income. So year after year, if we have economic growth, we have more people entering the market, entering the job market. So more people working, more people earning incomes. The incomes or the salaries of people is rising, or their gains from other productive activity is rising, and so there is more income, which means more income taxes, so more tax yield and more revenue for government to fund its activities, even if the tax rate remains the same. So while the tax rate might remain the same, but the increasing income of people means also an increasing tax income for government. So this is very important. So the potential of the tax for the tax to grow with with people's income is very important in order to cover the expenditures, or that also increases with the growing demands of the country's citizens. But but in the same time, we also need to look at the responses or the behavioral responses of the tax to the changing tax rates. So how changing tax rate can also affect the tax yield. So for instance, uh, we raising taxes on particular activities or particular commodities or something can affect the amount of taxes that a government can yield. So, for instance, if if income taxes rise so much, this might make people think of or trade off extra working hours for example, leisure time. Or when there are high sales taxes, or if sales taxes become too high, people might spend less on the taxed items where there are high sales taxes. So this might reduce consumption and sale of these goods. So these are also important considerations when evaluating or when predicting how much tax rate can we expect to get from the different types of taxes at different tax rates. So when considering changes to the tax rates, whether increases or decreases, what decision makers need to take into account is what effect this increase or decrease in tax rates might have on people's behavior, and eventually on the amount of tax that government can get from this tax. Also, the elasticity of demand on certain taxes. So think again of the cigarette taxes. Usually changes or applying or changing the tax on cigarettes, so adding a tax or raising the tax on cigarettes does not necessarily lead to a reduction in the consumption of cigarettes, because those who are buying cigarettes are usually addicted to it, and so they consume the same amount of cigarettes regardless of the amount of tax, and usually the amount of tax is not very substantial with respect to their income in a sense or in a way that would reduce their consumption. So by raising taxes on cigarettes, government may actually be able to get some extra money or some extra revenue from this. Whereas from other commodities, this may not be the same, as citizens, for example, might reduce their consumption of certain goods, or uh, might buy something else or buy some other substitutes for the goods where the taxes have been raised. So these are very important considerations to think uh, when thinking about revising taxes or changing tax rates, or predicting how much revenue can we get from certain taxes at different tax rates. The second principle of taxation is equity. So decision makers, when designing tax policies or evaluating existing taxes, need to take some equity or fairness considerations into account. The first concept here we need to consider is what we call the benefit principle. So, the benefit principle implies that there should be some relationship or some connection or some match between the amount of money that a taxpayer pays and the benefits he or she receives from these tax payments. So think, for example, or the best example of this is user fees. So when government actually takes fees or collects fees in return for certain government services or products. So think, for example, of paying fees in a public garage or a public parking lot, or paying for some of the services that government provides, like issuing birth certificates or passports or whatever. So these are payments that a person pays in return for a specific service or a specific product. And so this is a pure example of a benefit principle. However, most taxes, or the majority of the taxes, do not, or we cannot apply this benefit principle on the majority of our our taxes. So perhaps property taxes sometimes can uh, can in a sense approximate this benefit principle when the money collected from people in property taxes is spent on developing their neighborhoods or their cities. So the money is actually spent on providing services or developing the community in which those people live. So using property tax money to provide goods and services in the areas from which the property taxes were collecting, like paving the roads, building hospitals, building schools, etc. So, property taxes, if applied in this way, can approximate, in a sense, this benefit principle. However, we cannot apply this benefit principle to all government activities and to all types of taxes. We said that one of the important role of government is to provide the activities or to provide services that are of a public good. So government, or a lot of government services and activities, are essentially either public goods or goods that have a positive spillover or a positive externality, so that government needs to collect money. So a general tax, so you need to have a general tax pool and revenue that will be paid, or that is used to pay for all those government activities that are of public good, or that have a positive externality. So like paving all the roads, or like defense, like policing, like um, creating or like having uh, praying for foreign ministries and so on. So these are all examples of goods where you cannot apply the benefit principle of taxation. So you cannot really say how much a citizen is getting exactly how of these services in return to the amount of tax paid. So we cannot apply all of this to or all of the services that that government provides and all of the taxes that government collects uh, and approximate them or apply them to the benefit principle. There is also another consideration where some of the services like education or healthcare that people might have a demand on or that people need but unfortunately will not be able to afford. So in this sense, government will have to provide some form of these services in subsidized form at lower prices or even at low cost to the recipients of the service, and government will have to pay for that from its revenues and from taxes. So in this case, these are in a sense they are not only services that uh, improve or that benefit those who receive it only, but there's also a benefit that extends beyond the recipients or the beneficiaries because society as a whole benefits from having or from educating all the members of the society, because when we have educated people then businesses can benefit from having an educated workforce. Educated people means less crime, means people who are able to work to sustain them for themselves. So even if they are dependent on government subsidies for education, at some time over time they will be able to be productive and sustain themselves and not be dependent on government. The same with healthcare. So the entire society benefits from a healthy population. So again, a healthy workforce, less contagious diseases because people have access to health care. So we all benefit from these services, even if government provides them subsidized or at no cost. So many of these activities, we cannot apply the benefit principle directly. The second concept or aspect in relation to the equity principle of taxation is the ability to pay. So different taxpayers have different levels of income and wealth, and therefore their ability or they have different abilities to bear the cost of financing government activities and operations. And so according to the ability to pay principle, the taxes that a person pays should be related to his or her ability to pay the tax. So um, the ability to pay has in this respect two dimensions. So we have what we call horizontal equity and vertical equity. So by horizontal equity we mean that equal taxpayers or taxpayers with equal amount of income or wealth should be taxed equally, should pay the same amount of tax. So if we're talking about fairness and equity considerations in this regard, so this means that people, or if we want to have fairness among taxpayers, so people who are earning the same amount of income should be paying the same amount of tax. If we have in society people who are making the same amount of money but they are paying different taxes, in this respect we are violating the horizontal equity principle. So we want to make sure, or our tax system in a way, when we try to ensure fairness among people, we are trying to apply this horizontal fairness or horizontal equity dimension so that people at the same level of income, people who are making equal amounts of earnings are are not taxed differently, because if two people are earning the same but one is paying more in taxes to fund government activities whereas the other is not paying as much, this undermines the fairness of our tax system. However, while it seems very intuitive and very straightforward to say that people with the same ability to pay should be paying equal taxes, and usually this ability to pay is measured in relation to people's income, this measure, however, is not, this is not, however, as straightforward as it sounds, and it may involve some difficulties in applications, and often this horizontal equity principle is often violated because of our tax administration, which might erroneously identify two taxpayers as being the same or as having the same ability to pay when in fact they might be different. So think, for example, of two taxpayers. One is married and has two children, whereas the other is single, is not married, and has no children. And so the person who is married might have more obligations towards his family and his children, and so spends a lot of his income on supporting his family, whereas the single person doesn't have as many obligations. So while the criteria that they are equal in the sense of having equal income is identifies them as being having the same ability to pay, in fact the person who supports his family and his children may have a less ability to pay because of the other family obligations. Also, property taxes. The way we administer property taxes is that usually government would have to assess the values of property or the rental value or the market value or whatever type of assessment. If the assessment erroneously identifies two property as having equal value, and so requiring the owners of these property to pay the same amount in tax, while in reality, if these two property were sold, their prices would be different. So if they erroneously were assessed as having the same value, when in fact, if the two property were sold and those people got the money from their property, the sale value of the two property might be different, which means that the ability to pay for these two persons might be different as well. It's also a concern if uh, the value of property for some people might rise while others may not, and so people might be living in very expensive properties because of changes in the values of the market prices of property in the place where they live, but their income has not changed as much or has not increased as much, so they are in a sense property rich. That's, they have property with a very high value, but they're not earning income that allows them to pay very high property taxes as a response to the rising price of their property that has been assessed at a very high price. So in this case, the ability to pay is measured on the property value. However, people's ability to pay for property taxes, which they pay out of their own income, might not be, or might be a burden for them to pay it out of their own income. So again, applying the horizontal equity, or making sure that really we are taxing people with the same ability to pay equally, is not really that easy to apply. The second aspect related to the ability to pay principle is the vertical equity. By vertical equity, we mean treating different taxpayers differently. So people or taxpayers with different abilities to pay should also be treated differently when it comes to taxes. Uh, And so, judging on the vertical equity of taxes, we need to know more than just the tax rate at which a tax is administered, but rather we need to calculate what we call the effective tax rate. And so, what we really need to know is how this given tax affects the different people or different income groups in order to make a judgment as to whether the tax is progressive, proportional, or regressive. So a progressive tax is one where the effective tax rate it would be higher for higher income taxpayers compared to lower income taxpayers. So which means that the higher income taxpayers would be paying a larger percentage and a higher effective tax rate and a larger percentage of their income in tax compared to lower income earners. Uh, the opposite would be a regressive tax, where actually the tax or the effective tax rate would result or would be in a way where lower income taxpayers are paying a larger percentage of their income in tax compared to higher income taxpayers. And a proportional tax would be one that has the same effect on all taxpayers. So the effective tax rate would be the same for all income groups, so regardless of whether they are earning more income or a high income or a low income, everyone would have the same effective tax rate in a sense. Uh, in generally, and especially for income taxes, there seems to be agreement across most societies that income taxes should be in a way progressive. Usually the progressivity of a tax signals more fairness, because we say that people with higher income earners, people who have better ability to pay, should be taxed proportionate to their income, whereas those who are at the lower end of the income categories, or those who are earning much less, should not be given so much burden in taxes. And so we think of progressive taxes usually as signaling more fairness. And so there might be, or there are often agreement on the progressivity of taxes. However, there is there is usually, or there isn't consensus across all societies as to how progressive a tax should be. So whether or how much more should we tax higher income earners, or how much less should we tax lower income earners, or how much should we exempt them. These are issues that are usually controversial regarding tax codes and tax laws. So what's the percentage of taxes that should be applied to different categories of incomes, and the progressivity of the tax, to what extent it is really progressive, the highest bracket, how much should it be, 30, 40%. So these are often controversial issues. It's also important to note that judging whether a tax is really progressive or regressive or proportional is not really that straightforward, because we have to calculate the effective tax rates. And so let's look at a couple of examples as to how we measure these effective tax rates on the different types of taxes and the conclusions that we get from them. The first example we have here is for income taxes. So we have here we have two taxpayers, taxpayer 1 and taxpayer 2. So taxpayer 1 has an income of £25,000, whereas taxpayer 2 has an income of £50,000. So if taxpayer 1, or the income tax that taxpayer 1 has to pay, is £2,500, whereas taxpayer 2 has to pay £6,000. So in order to calculate the effective tax rate, we divide a tax paid by the income. In the first scenario, taxpayer 1 would be paying 10% of his income as tax. So the effective tax rate for taxpayer 1 would be 10%, whereas for taxpayer 2, dividing 6,000 by 50,000, the taxpayer the effective rate for taxpayer 2 would be 12%. So in this case, this tax, or the administration of this tax, or this income tax, is actually progressive, because taxpayer 2, who is earning a higher income, £50,000, is actually paying a higher percentage of his income, that's the effective tax rate, as a tax, compared to taxpayer 1, who only pays 10%. Moving on to the next row, if these two taxpayers, so if taxpayer 1 still pays the same amount, so £2,500 of his income as tax, so his effective tax rate remains at 10% as well. But taxpayer 2 in this scenario pays only £5,000 in tax from his income. In this case, taxpayer 2, or the effective tax rate for taxpayer 2, would be 10% only. And so this would be a proportional tax, because both taxpayers, even though they are at different income levels, they are earning different incomes, they are paying the same effective tax rate. So it is not only judged in monetary terms. So even though taxpayer 2 in monetary terms is still paying more, so £5,000 compared to only £2,500 by taxpayer 1. However, the effective tax rate is the same. So the burden of the tax on both taxpayers is the same, only that's 10%. And so in this case, the tax would be proportional. So the effect of the tax on both taxpayers in this sense would be the same. The third scenario, looking at the last row, if taxpayer 1 still pays £2,500 from his income, whereas taxpayer 2 in this scenario only pays £4,000 in taxes from his income. So in this case, taxpayer 1 would be still paying 10% of his income as tax. So 2,500 divided by 25,000 again is the same 10%. Whereas for taxpayer 2, this effective tax rate changes and actually becomes less, because now he's paying £4,000 from his £50,000 of income. And that results in an effective tax rate of only 8%. So in this case, the burden of this income tax on taxpayer 2 is actually less than taxpayer 1, because taxpayer 2 is paying only 8% of his income in tax. So even though in monetary value, in all three scenarios, taxpayer 2 is paying more money than taxpayer 1, however, the effect of the tax on taxpayers' true income is different. In the first scenario, it was progressive, so the effective tax rate was higher for taxpayer 2 compared to taxpayer 1. In the second scenario, the effective tax rate was the same. In the third scenario, it was a regressive tax, where taxpayer 2 is only paying 8% of his income in tax, even though he's still paying more in taxes in monetary terms compared to taxpayer 1. So judging the progressivity of a tax involves more than just looking at monetary terms. We need to actually calculate the effective tax rate in order to find out how much the tax affects taxpayers, and how this effective tax rate, whether it looks progressive, proportional, or regressive. Well, let's look at a second example related to sales tax. So here we have two families, family A and family B. Family A has an income of £25,000, whereas family B has an income of £100,000. So both family A and family B make some purchases on items where there is a sales tax applied on these purchases. So family A purchased items worth of £20,000. These items are taxed, whereas family B spent £60,000 of its income on taxed items. The sales tax here is a constant tax at 5%. So family A, if we calculate 5% on the purchases of family A, so 5% of the 20% paid by family A, that would be £1,000, whereas family B paid £3,000 in sales taxes, the 5% of 60,000 that they paid on the items that they purchased. So here, family B paid more in taxes in monetary terms, £3,000, compared to family A, which only paid £1,000. However, in order to judge whether the tax is progressive, regressive, or proportional, we need to calculate the effective tax rate. So we need to divide the amount of tax actually paid by each family divided by their income. So looking at a family A, so the amount of tax they paid in sales tax, £1,000, divided by their income, 25,000. This means their effective tax rate is 4%. Whereas for family B, uh, the amount of taxes that they paid is £3,000. We divide that by their income, that's the £100,000. So this results in an effective tax rate of 3%. So even though family B earns more, and they make more purchases in or they spend more, they pay more taxes in monetary terms. However, the effect of the tax on family B is less than the effect of the tax on family A, and this is why we say that sales taxes or in this example, sales taxes are regressive, because even though family has made less purchases and has made or has paid less in the tax, however, the burden of the tax is higher on their income, that is 4%, compared to the burden of the tax on family B's income, that is 3%. And so in this example, the tax is regressive, and usually this happens because poorer families or lower income families, they usually spend more of their income, and so they pay more of their income, and so they pay taxes on their purchases, whereas higher income earners tend to spend less of their income and to save a large proportion of their income. And this is why sales taxes can be regressive in a sense, and that's why, as we'll talk about sales tax later, in most countries, some items, especially food or medicine, are exempt from sales taxes in order to reduce this kind of regressivity of sales taxes. But what is important to look at in this example here is that judging whether a tax is progressive, regressive, or proportional, we need to look at the effective tax rate. So even though the sales tax seems straightforward, 5% constant for any purchase of items upon which there is a tax, or there's a sales tax, in reality, the effect of these tax on the different taxpayers can be different, and the effective tax rate for people with different incomes can eventually be different. So it's important when judging whether a tax is progressive, regressive, or proportional, is to look at the net effect of this tax on the taxpayers. And this is really also important for decision makers when deciding their tax policies, when looking at fairness considerations, is to look at the effect of the tax on the different taxpayers and the different income groups in society, so that, or in order to be able to design a tax structure or a tax system that is more equitable and more fair. The evaluation of taxes and their effect on the different taxpayers is also complicated by understanding the tax incidence. So, by tax incidence, we mean who pays the tax. And so, we usually have, or we can have two things here. So, a statutory incidence, that is, who is or who should pay the tax as stated by the law. So, what does the law say about who is obligated to pay the tax? Versus what we call economic incidence, that is, who actually pays the tax, to whom is the to whom does the tax burden falls. So who actually have to pay this tax out of income, whose income is being reduced as a result of an application of a tax. Can these two be different? Can the statutory incidence be different from the economic incidence? Can the law say that one person should be paying the tax whereas another person is actually paying the tax? So think, for example, of property taxes. So property taxes, if some of the property is, or the property taxes, usually the law says that the owner of the property is the one who pays the tax. However, if some of these properties are rented, so property owners are renting their property, what these people can do is that they can raise the price of the rent so that they can cover the taxes that they have to pay in addition to the income that they want to get from their the renting of their property. Whether they are able to shift the entire tax burden or part of it to the tenants or the renters, or those who rent the property, of course is subject to the price in the market, supply and demand and all that. But the idea is that sometimes the person who are by law required to pay the tax, that's the statutory incidents, are not necessarily the ones who actually pay it, and sometimes they are able to engage in some form of tax shifting so that they are able to shift part of the tax to another group of people, in a sense. Look at the sales tax, for example. The sales tax by law, it's actually the business owners or the sellers are the ones who are required to have a sales tax on all of their or on whether it's all or some of the commodities, or some of the products or services, or whatever. But they are the ones who should pay a sales tax to the government. However, the sales tax is usually added on to the price of commodities, and the buyers are the ones who pay the sales tax. So here we have, whereas the law says businesses have to pay government a sales tax on every unit of product or service that they do that is subject to the sales tax. In effect, it's really the buyers who are the ones who pay for the sales tax. So the ability of some taxpayers, or the ability of some people to shift the tax to other groups, is also important when looking at taxes or when evaluating taxes, because decision makers have to take into consideration the effects that these taxes have on the different income groups. So, for example, when considering property taxes, so you might want to consider as to how the prices of rent rises, especially for people who are unable to buy their own homes and they have to pay rent. So this might mean that they also have to pay for the additional burden, or for taking some of the burden of the tax as well, that they will have to pay of their income in paying a higher rent because the taxes have raised the prices of rent, and so on. So these are also considerations that decision makers would have to take into account when evaluating tax policies, and how the taxes and the structure of the taxes and the administration of the taxes affect the different groups in the society differently.